Good morning. Nice to meet you. Thanks for coming. My name is Alon. I run Intel Ignite. We're very much happy to have you here and to throw this with our lovely friends at Entrée. Intel Ignite, for those of you who don't know, is Intel's accelerator program. By far and large, kind of the most, that's not me saying, they were like, we have a great reputation, read about it in all of the different various outlets, but Intel Ignite is an accelerator program. We've been around for 4 years. We see roughly, we have 2 acceleration batches every year. Right now we're running cohort number 8. And what we give startups is kind of help in their tech go-to-market, help them build their companies basically, and also provide exposure to Intel. We see roughly 250 startups before we start each batch, and we end up selecting 10, so it's very hard to get in. We love working with founders that build in deep tech. So everybody in the room is probably relevant, okay? If you guys are building, if you're an entrepreneur building in the Web3 space, particularly, by the way, in things that have to do with infrastructure, feel free to come and talk to us. The kind of dry cutoff criteria is you have to have raised over $1 million in funding, and obviously, like, be relevant and interesting for Intel. Intel is interested in Web3 in many different ways and facets. We're always interested in learning about new types of compute, new workloads. Web3 is definitely a big opportunity for that. We have a big, although people don't know that, like, we have a big kind of Web3 setup within Intel. I'm also a part of the Web3 steering committee within Intel, so we're very much happy to hear about what you guys are doing. Aside from the fact that we're happy to have Entrée, we're also proud to feature current batchie, Michal, with Tweed and Bentzi, who graduated from the previous batch. So we're active in the space and we'd love to hear from you. And that's it. Good to have you. Thank you.
Thank you, Alon, and hi everyone. My name is Tomer. I'm leading the Web3 investments at Entrée Capital. It's great to see many familiar faces. This is our 3rd meetup. We try to do one every couple of months. Today we will speak about the future of crypto wallets. First, we have a special guest guy from Kraken who will share with us some current market updates about what's going on in the US and the crypto regulation there. And then we'll have a panel of some people that we gathered from the street, random people. I'm kidding. Panel of rock stars. All of them, all the panelists are founders and CEOs of startups that are involved in the wallet, crypto wallet industry. Perhaps if we want to do it a bit more dynamic, you're welcome to raise your hand if you have urgent questions during the panel. Although I don't think that we will hear you in the recording, but we can just say the question and panelists will answer. And that's it, I guess. Maybe just another one word about Entrée Capital. So we manage $1 billion. We have more than 150 companies in our portfolio. We are generalists. We don't do only Web3. This is basically what I do, and the other colleagues at the fund are doing many other types of industries, including investments in SaaS, AI, cyber, dev tools, and other things. If anyone here doesn't have my direct, I don't know, Telegram or email or LinkedIn, feel free to ask the person near you, and you're welcome to send me a message with your ideas or a deck, or just if you want to meet for coffee or anything else, then you're more than welcome. And that's it. So we'll start with Guy Hirsch from Kraken. Thank you.
Thanks, Tomer. Hi, everyone. My name is Guy Hirsch. I'm the Global Managing Director for Kraken. So just a little bit about myself. I started my career actually with Ouriel here raising money for my second startup from the Lightspeed Gemini venture lab. And what's interesting, I was thinking about it yesterday, is that he invested in one company that ended up, not kind of exiting, but one of the founders is now a VP product at eToro. Then he invested in me. I'm now at Kraken, and now Ouriel is doing ZenGo. So, kind of interesting. So I started as an entrepreneur. I sold one company that was in the homeland security space. Then I started another company that was at the beginning kind of a social investing app, and then morphed into more of a enterprise software. That company went through a number of pivots. I ended up at Samsung, spent 4 years there. My last role was Director of Innovation Strategy. I was overseeing all this kind of strategic initiative of Samsung North America. Then Yoni Asya, the founder and CEO of eToro, offered me to lead eToro's expansion into the US. And at the time, it was December 2017, Bitcoin was at 19,000. And it was an opportunity for me to be like all in on crypto. The idea was to build like a crypto brand in the US for eToro. Up until that time, there wasn't anything eToro did in the US. And so I jumped on the opportunity and built eToro US. It was very exciting. We kind of built a brand, and eToro today is a player in the US market in both crypto and equities. I then was promoted to be in a global role and try to figure out how to bring eToro, which is basically a broker that's working on principal base, how to bring eToro into the kind of non-custodial space, how eToro can play in DeFi, allow users to buy NFTs, allow users to stake, do all sorts of interesting things, and that was really, really challenging and interesting opportunity as well. And in October, I was offered to lead Kraken North America. So I saw an opportunity to kind of be part of a crypto native company, and moved over to Kraken. About a month ago, was promoted to be global managing director. So today I oversee all of Kraken operations worldwide. We're operating in 60 countries. We have offices in Europe, US, Canada, Australia, a number of other places. I also oversee corporate development, business development, banking, payments. I'm the liaison to Kraken Ventures, and I'm also overseeing 2 companies we acquired. One of them is called CF Benchmarks, which is a leader in indices. CF Benchmark, for example, is quoting the Bitcoin price for the Bitcoin ETF that's trading on the Canadian Stock Exchange. So a bit about Kraken, for those of you who don't know. Kraken was founded in 2011 by Jesse Powell, the founder and CEO, with I think there are 2 other co-founders. And as a crypto exchange, so crypto native, and not just crypto native, also remote first company from the get-go. Back then it wasn't like Zoom or anything, but the idea was to build a really distributed company, global company that would allow people to, or would accelerate the adoption of cryptocurrency worldwide. That's the mission. And the company grew substantially. Today we have more than 10 million customers worldwide. We have more than 2,000 employees. We have multiple licenses in various jurisdictions. It's really a success story. So I think what's interesting from to kind of contextualize it to today is that when we talk about wallets, there's obviously a lot of kind of great innovation in the space, and a lot of interesting companies are doing all sorts of very cool things. But there's also the kind of the core of the exchange, which is also kind of to custody our customer assets. So to have custodial wallets, to have that responsibility to sit on people's money and manage it in a proper way. And there needs to be a lot of innovation in that space too. The innovation is not just technological. So yes, we obviously are into MPC and a lot of kind of under interesting opportunities, but it's also regulatory and it's also operational. And there's also a need to innovate on the insurance space because when you try to eventually sell institutional customer to have some sort of a custody solution to say, hey, you can trade on the exchange, but you can also custody with us. You can safely have your assets with Kraken. That comes with a lot more than just technology. That comes with sales, with account management. That comes with SOC 1, SOC 2, like a lot of things that you need to show institutional players when they come into the space. So particularly about insurance, I think there's a lot of opportunity there. Right now, I think the market to cover all sorts of cyber events associated with custody, a lot of kind of potential hacks, insider embezzlement, things of that nature. I think there's a kind of ton of opportunity in insurance to be a lot more of a mature market to provide that extra layer of protection beyond the technological protection of who holds the keys and how do we do key management and cold wallets and so on and so forth. That is something that I'm interested in because it's a mechanism that allows more adoption of crypto and allows for more money to be deployed if there's going to be some movement. Then on top of that, there's the kind of operational and regulatory aspect of it. There's a SEC proposal right now for registered investment advisors in terms of who can be a qualified custodian for crypto, and they include crypto assets in the proposal. That proposal has a lot of kind of potential ramifications on our industry, in particular, obviously in the US. And Kraken, but other industry participants are working very diligently to try to influence the outcome of that proposal so that it won't be something that blocks registered investment advisor, asset managers in the US that obviously sit on the bulk of potential crypto assets to be able to allocate to crypto by using a qualified custodian that answers that rule. So there's a lot of lobbying work, there's a lot of legal work that goes into allowing kind of all of us to be successful, because the market isn't just, again, as I said, about technology. So that is something we pay attention to very, very closely, and trying to understand how we can partner or work together with stakeholders, SEC, but other players to augment the proposed rule to make sure that crypto can continue and flourish, and crypto players can be deemed as qualified custodians for RIAs. I think that another point is that, and Jesse has been very public about this, is that yes, we're a centralized exchange, but we vigorously support and promote the idea of you owning your own keys, having your own wallet, and when you're done like trading, when you're done using or leveraging what Kraken has to offer, that you have and you know how to use your own wallets and own your own keys. It's something we hold very dear and near to, like how we see the world. And so we have, as a company, a vested interest to continue to promote that, even though it has sometimes or oftentimes not a direct contribution to our revenue, to our top line, or sometimes it's even contradictory to what we're trying to do. But the notion and concept of sovereign individual owning their own assets and owning their own money is at the heart, I think, of what we do. And so we invite people who have opportunities, ideas, startups, ways to kind of advance that notion to come work with us. And we have like various ways in which we can participate, even if it's not directly linked or, as I said, contradictory to the exchange. And that is through either Kraken Ventures or a potential biz dev opportunity or potential even some sort of like a co-marketing. We just have a vested interest in that, and we want to see that continue. And we want to see more and more people understanding that they can own their own assets. They can have kind of a censorship-free way to build their wealth and protect their wealth, no matter where they are. It's, as I said, it's at the heart of what we believe in. Maybe one kind of last word on kind of an outlook of a global company trying to compete in crypto. I would say that now, having spent like 5 years at eToro and now at Kraken, I think there's when you build these companies, there's sometimes like a kind of a funny notion to think about it, where basically what we all are in the space is a kind of a giant kind of regulatory machine complying with multiple licenses. They just happen to have an exchange. They just happen to have like a side business that they're making money off, because so much work is going towards the licenses, compliance, regulation, operation in a way that not just is geared towards making sure that the licenses are there or their compliance is there, but also that we bring in concepts that when implemented would provide an opportunity for us as an industry, not just Kraken, to say, this is why it's so much better than TradFi. This is why it's so much better than how we're doing things currently in traditional assets. One such concept that Kraken introduced is proof of reserves. So because of blockchain, we have an opportunity to show our customers that the assets we tell them we have is actually here. And here's the blockchain. Here's like, point your browser to to the address and see that we actually are custodying the assets we told you we're custodying. That is something that in TradFi is very, very difficult or impossible to do on a real-time basis, right? TradFi, you have an auditor, goes in every so often and checks all sorts of things. With crypto, in proof of reserves, you have the opportunity to show it on a 24/7 basis. So I think beyond the compliance and regulations, there's really an opportunity to show the myriad of stakeholders involved with like a global company like Kraken of why moving the entire financial services industry to blockchain rails is a good idea. So we definitely are excited to continue to introduce concepts like proof of reserves to show that and continue to advance the cause of crypto. Anyway, I think I'll wrap with that. You came to hear about wallets, so I'm not going to spend a bunch more time, but I'm happy to kind of socialize later and talk to anyone who's interested, and I hope you enjoy the panel. Thank you so much.
Thank you, Guy, and now I'd like to welcome our panelists, Michal, Itai, Ouriel, and Bentzi. Bentzi, oh, he's there. Hey. So maybe we'll start just by a very quick introduction of each one of the panelists, and then we will start.
Hi, everyone. My name is Michal Latzer. I'm the co-founder and CEO of Tweed. We are a white label self-custodial wallet as a service and payment SDK. We work with companies to help them onboard mainstream users in a compliant and frictionless way.
Hello, my name is Ouriel. I've already been introduced by Guy. By the way, I also invested in companies that exited, so. But now I am on the other side, and I've been building ZenGo, which is a leading wallet in the crypto space, non-custodial. We pioneered MPC, that category that now is very, very rich and very dense. And I'm sure we'll talk more about that.
Hey everyone, I'm Itai. I run a company called Dynamic. We essentially are building Auth0 for wallet-based authentication. So if you go to sites like Sound.xyz or TokenProof or Utopia, etc., and click login, that entire system is essentially powered by us. And that means whether you have a wallet, whether you don't have a wallet, your entire user management is essentially powered by Dynamic. We're backed by A16Z and Entrée Capital and others. And so we get to partner with a lot of wallets. We don't build our own wallet.
Hey everyone, I'm Bentzi from Utila. We are building an enterprise-grade self-custody solution for organizations in order to help them manage their crypto assets. We are also MPC-based, like ZenGo, but we are more in the B2B side. We help organizations create wallets in scale, manage users, permissions, and addresses.
Cool. So we started from Guy speaking about the custodial efforts of Kraken, and I think that now we're going to draw a line from custody to non-custody wallets, and speak about wallet management, passwords management, user experience, decentralized identity, and all those things. So maybe we can start with Michal. So you started the business and decided to go for non-custodial wallets. So maybe you can share with us a bit about the difference that you see and the pros and cons between custody and non-custody, and also why you thought that it's best for your clients, which are mostly brands or corporates, to launch non-custodial wallets.
Sure. So I think I'll zoom out a little bit and kind of give a brief overview of custodial versus non-custodial wallets, which I'm sure most of you guys know, but just as a refresher. So in traditional finance, we all know custody providers are ones that are there to safeguard a user's assets, securities. They're there to protect them from being stolen, lost, etc. And with that, as a custodian, especially if you're a global one, you have to adhere to certain rules, regulations, laws that come with financial licensing. So you have to adhere to certain liquidity measurements, fiduciary responsibilities, AML, etc. In the digital asset space, and I'll caveat by saying that I'm specifically speaking about externally owned account wallets. Custodial wallets are provided by entity that safeguard their private key on behalf of a user, which means that entity has full control over the user's asset, the user wallet, etc. And from a user perspective, if you trust that custodial, you really have kind of like that comfort knowing that the entity will protect your keys, that you can always retrieve it. It's a derivative of that is obviously phenomenal user experience because you don't have to keep your own keys. You can always regain access to your funds. And the self-custody side, the user, the owner of the wallet, is the sole owner of the private key. They're the only one that can actually have access to the private key. A third party, in this instance, can help generate the wallet for the user, can add a layer of protection for the private key for the user. They can even add some mechanism of wallet retrieval for the user, but in no given moment, this entity can actually have any touch point with the private key of the user. So if we're, again, like being a little bit more specific, in EOAs, the private key has to be both generated, encrypted, and decrypted on the end device of the user, so there is really no way for a third party to actually have any touch points with the private key. So traditionally, self-custodial wallets have been known for a very kind of questionable user experience. You have to remember a very long seed phrase. If you lost your seed phrase, you lost access to your wallet. We all know the story. It's no longer the case, obviously. We have Ouriel, ZenGo here, and the consumer wallet side have been evolving tremendously. Also, on the B2B and the infrastructure side, which we operate in, there's been significant improvement in recent years. And today, users no longer really have to choose between user ownership and user experience, which is a big step in the space. And I mean, I want to specifically touch on from the company perspective when companies choose to implement wallet infrastructure into their stack, because that's primarily what we work on and deal with on a daily basis. regulation has been kind of a key theme for companies that are not financial institutions, so they don't own financial licensing. Therefore, with the evolving regulation, I'm sure we'll speak about MiCA that passed Parliament in the last few weeks. There's now a clear distinction between what a custodial solution would require versus what a self-custodial solution would require in terms of licensing, etc. And we noticed it a lot in our discussions with companies, this shift towards self-custody, not only from the perspective of what the user, would want to own and feel like from a brand perspective, but more from a regulatory perspective. They want to have the freedom to let their users hold crypto, asset tokens, NFTs in a compliant manner and really appeal to users globally from day one, and they can only really do it with a self-custody infrastructure.
Cool, so thank you very much for the detailed answer, and well, I think that now we kind of understand what does it mean to have custody versus non-custody, and I guess that MPC is something in between. So maybe you can tell us more a bit like the different types of encryption for wallets, and specifically what you do, and maybe also you can refer to the latest PR incident that happened to Ledger. Obviously, we have to speak about it, which maybe demonstrate the debate between hardware wallets and are they safe or not, and how exactly can someone save their own private keys.
Fantastic. Well, will you first not your screen and not your panel? So please turn off the light if you can. Can't speak like that. It's difficult to look at you. How to get started? Let's start with very basic principles. Humans are terrible at keeping secrets and keeping passwords. That's it. Once you know that, you understand 99.99999% of the problems that there is in crypto. Whether they are related to wallets, to smart contract security, and even to custodial businesses. And Guy, I'm sure, can share a few stories. I don't know if he can, but he could, about what he saw in the past. It's handling password security is a terrible thing to rely upon. And so what you want when you embed into a security system is to make sure that the choices that you have to make as a user or as a developer are as simple as possible so that you understand them in order to avoid mistakes and avoid external attacks. It so happened that the vast majority of non-custodial crypto wallets, so the typical software or hardware that you choose to control the assets, whether they are coins or NFTs, are based on a single factor secret called a seed phrase. It's a series of 24 words. And it so happened that so many people, there is an estimate of $100 billion worth of crypto have been lost because of that principal security factor, the seed phrase. And so what can we do about it? How can you improve that? How can you make sure that you still leave control to a user so that he's not a liability to himself, but also protected while keeping the control of his assets and not necessarily relying on a custodian? Not just because it's not good to rely on a custodian, by the way, it's not necessarily bad, but you also need to be on chain to do certain things. There are things you cannot do with a custodial system. You can't do NFTs, you can't do on-chain gaming, you can do on-chain social networking, etc., etc. You can't do DeFi. So you need that. It's not just like a better thing, it's a must-have thing. So what else can we do? Well, there are new innovations that have been playing out for the past few years. We have been pioneering one of them. It's called MPC, multi-party computation. The principle is simple, at least to describe. Instead of relying on a single factor and a single secret, you rely on multiple secrets that don't know each other. And therefore you can build upon that sophisticated authentication mechanism that are not a single point of failure. Okay, and so if you want to see how it plays out, I invite you, by the way, how many people have a wallet here, a crypto wallet? Okay, so good. So now you throw it away. You download ZenGo, and you say, welcome to the future. You will see how MPC at work can play out and the substantial improvement in user experience that you can enjoy by not relying on a single factor, which is the seed phrase. Terrible onboarding, terrible recovery process. And so to join your, there are other techniques, by the way, that have been used in the past, still being used today. There is multi-sig. Probably the best illustration of that is SAFE, formerly known as Gnosis, which has a really fantastic service, although it's only limited to Ethereum and EVM. Basically allow multiple people to collaborate around an on-chain non-custodial wallet with different functions. And you have Shamir Secret, which basically is a patch between MPC and seed phrases, where you take a seed phrase and you split that seed phrase into multiple pieces, and somehow you reconstruct it by encrypting it, decrypting it. So we have to talk about that. I will not be too long because I want to make sure everyone has time. Ledger, which is a very, very well-known leading hardware wallet, has announced 2 days ago that they are launching a recovery service, which is basically a little pale copy of what we invented 4 years ago, where they take the seed phrase which they've been built upon, and by the way, it's funny, on their own website, they say it doesn't work, that people lose their phrases and everything, so they already blame themselves for what they've been doing for a few years, but they take the seed phrase, they somehow split it in pieces, encrypt it, and share it in the cloud, and of course, that has been a terrible PR fiasco. By the way, just a PR fiasco. It looks like the implementation is extremely problematic. It's built on KYC, which is like anti-crypto. It's custodied by companies or parties that are not well known, not well understood. And finally, it's a paid service. You have to pay to recover your wallet, which is really, really weird. $9.99 per month. So there is other issues in implementation. So what we see is we start to see legacy players, so not just innovation in the space, but legacy players to try to put some band-aids on what they've been building for the past years. Unfortunately, you cannot solve the original problem, the seed phrase of death, the fact that you still depend on one single factor that can compromise your experience, your funds, and maybe even more. So I think there is an untapped opportunity to first reset and revamp the entire non-custodial space. I think we're one of the companies, but many more that try to do that. I think there is rules that need to be rewritten. I think what happens to Ledger is a good thing because it will help people question what they thought was the right thing to do. And I think there needs to be, of course, a lot more education in terms of what can be experienced, and people need to try those new systems that are being built today. I'm sure we can talk more about that. I want to pause because there is more things to discuss.
Thank you very much. I'm moving to Itai. So you mentioned that Andreessen Horowitz backed you, and obviously they're known for investing in very good ideas. So I think that it will be interesting to hear from you what kind of gaps have you identified in the market that's made you establish Dynamic.
Sounds great. So first, just to your point on the humans are terrible at kind of, think about passwords. They're also terrible at keeping actual devices, right? So by definition, you lose your phone, you lose your ledger, your phone gets stolen, right? So all these recovery methods have to think not just about you forgetting a password, but you actually losing physical access to your device, which is super interesting because it expands the problem set you have to deal with as a user, right? I think you made an important point, which is one of the cool things. I operate on the other side of kind of wallets, right? I essentially, in Dynamic, sits within websites and kind of lets wallets interact with those websites. And the vision for Dynamic is actually pretty much that if you fast forward 5 years, the way you interact with sites and apps is not email-based login, so you don't go to a website and create an account, but rather you connect your wallet and you interact with the website that way. It enables kind of connection and payment, connection in multiplayer mode. You can carry information with you. And the first step to that is, to your point, moving everyone to kind of wallets that sit on their phone or on their browser and let them interact. And that's usually non-custodial wallets, right? The magic of Web3, not to overuse the term, is the fact that you can start really doing things with crypto or doing things with decentralized identity that you can't do anywhere else. And so there's a lot of innovation on that front and a lot of really interesting problems there. But the reason, just on the reason we founded Dynamic, is that believe that you're fundamentally going to change the way in which you interact with sites and apps to a much deeper interaction based on wallets. In terms of interesting things that I think are going on in the market, and to your point, is I think what we're seeing is really interesting, and I think you're seeing it here in this panel, is everything is turning into a wallet, right? One way or another, and that kind of takes multiple forms. The first one is you're getting a lot of kind of incredible kind of self-custodial wallets that are branded wallets, right? ZenGo is an example of my favorite wallet. But not yet, but I expect afterwards. But essentially, they're example of branded wallets, right? That are coming out, and there's an acceleration of new wallets launching, not a deceleration, which is super interesting in the market with 250 wallets. Is that you're getting wallets like Uniswap to launch, and you're getting wallets like Family that are just launching now. So there's really kind of an acceleration of expansion in the wallet space. Then you get two other types of wallets. You get existing applications on your phone turning into wallets. And a good example is Coinbase kind of switched their entire user base and spun up kind of an MPC-based solution on their main app that turns 70 million users into wallet users, right? So with the flip of a switch, they turned an application on your phone into a wallet, right? And then there's a third part, which is turning kind of applications on a browser, essentially kind of websites and apps into wallets as well. And that's where I guess Tweed comes in, right? Which is essentially more on the, you click, you don't have a wallet, and in a click, you generate a wallet as part of a first interaction, kind of for guest checkout and things of that sort. And so what's really interesting, based on back to the innovation point, is that you're fundamentally seeing everything turn into a wallet, which creates opportunities for on the infrastructure side to help companies turn themselves into wallets. A good example is, again, Coinbase Wallet as a Service or Portal or a bunch of other providers there. You get a lot of interesting companies that help turn dApps or applications into wallets, and you get a lot of branded wallets. And that for me, is the super interesting thing that creates a lot of opportunities on kind of, you know, a future where everything becomes essentially a wallet. And I say this as a non-wallet provider, so having said wallet about 50 times within the last 2 minutes. That's pretty much it.
Thank you, and I think we will get back to it later, speaking about like the future of wallets, which is the panel name. Like, what exactly is going to be a wallet? Is it like the future account or whole identity, and what exactly is it going to store? And now moving to Bentzi, into the B2B institutional side of things. So I think there are several interesting questions. First, like the main question about custody versus non-custody. Where does it meet the institutional space? And second, we talked about regulation. So, you know, obviously custody requires a lot of regulation. Does non-custodial institutional wallets, can bypass regulation or solve some of the problems? And how do you see the regulatory environment evolves?
Yeah, sure. So I think I can talk about it for a few hours. We'll try to make it short. Yeah. I think that in the end, when we talk about institutions, so there are some common challenges and there are some different, like, new challenges. So a common challenge is like the key management, right? So, but usually in an institution, it will be not only like one wallet, it can be like more than one, it can be 5 wallets, and where it can be 5 million wallets, right? It really depends on the organization, the implementation. Some organizations, they will go on like omnibus account, which is like, imagine that there is one big wallet that is managing a lot of Bitcoins, and then there is just a database where they update like whenever someone is buying or selling. But when it comes, for example, for DeFi or like more on-chain activities, that they will actually need to spin off like different wallets for different users. And besides of the key management, so I would say another layer of risk is actually permissions, like user management. If you think about it, in every point when there is an organization that touch money, or even a team of 2 people or more, so imagine a bank account, right? Imagine a corporate spend management solution like Brex, like Ramp, like Mesh here in Israel. So this solution actually requires from their team to set policies, like if I'm moving more than X, then I need 2 admins to approve it. And if I'm moving something from a specific account, then I don't need any approval. And the same thing you also need when you think about the wallet side. So it's like how you can, besides of making sure that no one is like losing the key, or you make sure that a bad actor is not accessing the key. It's also how you make sure that you set the right governance over the crypto assets that you hold, which is a very critical layer for many organizations. Now, when as a startup, many times I'm being asked, what like the biggest challenge that you solve for organizations that you sell for, that my question is mostly governance. Like I think that the key management is a very critical part of it, but in the end, the governance layer is like the additional part that is super important for organizations. In the end, you can manage your keys very well, and then by setting the wrong policy, you can let someone in your organization to transfer all the funds by mistake to his grandmother's wallet, right? So this is why it's something very critical in organizations. Again, every organization has the ability to decide if they want to self-custody or to custody. In the US now there is still some sort of challenge because the SEC are trying to impose some new rules. So till now, let's say if you were like an hedge fund in the US, you could basically decide if you want to custody your assets in a qualified custodian. Think about Paxos, for example, Coinbase custody, right? BNY Mellon. Or if you want to self-custody by yourself and do it by Utila, by Fireblocks, or any other like self-custodial B2B wallet. Now there is a proposal that basically says that no matter what you hold, whether it's like a Bitcoin, whatever you do something like on DeFi, or you hold a cat, you need like a qualified custodian for that. And I think by design there is a challenge here, because for many things, like as Ouriel mentioned before, for example, when you need to do more like on-chain activities, it's much more difficult to do it like through a QC. You will need your own wallet many times, and it's like generating new challenges. And I think that there is still like way to go. So in the US, no one knows yet. Like we talk to many customers. Some of them, they are going now in the gray area, and they say, okay, for now we are still continuing with self-custody. Some organizations prefer to wait and see, and maybe they will move to a QC, which actually open a new potential market. Think about every large financial institution in the US. Now they understand that maybe they can be actually those ones who are custodying crypto and moving away all the self-custodial players, if that makes sense. But this is what's going on in the US specifically. I think in Europe, for example, they set like more clear framework around custody. You can basically decide as an organization if you want to self-custody or if you want to use a custodian. You do need to do it in an enterprise grade level, which means that you need to set clear rules on how you manage your keys, how you set policies around it. And I think Europe in the end is moving in the right phase, in the right direction, and while the US is still in a big question mark. And I think the rest of the world is actually also feels like going like Europe, like more regulation, more clarity on who should custody, what it means to be a qualified custodian. Also in the US, it's not clear yet. Like, what is a qualified custodian is another question. Like, let's say Paxos today, they are like still not sure if they are considered right now a qualified custodian, because now the rules say that maybe a qualified custodian is not someone that got like a state license. You need like a federal license. It's still unclear, right? So everyone is just waiting to see what will be the rules there. But Yeah, returning to your question, I think the main challenge in organizations beside of the key management is the governance layer. Yeah.
Takes time to pass the mic. Yes, but by the way, if anyone else want to refer to regulation challenges, so feel free. If not, maybe now we'll have some open questions to the panel about community management and identity. And I remind you again, if you have any questions now, you don't need to wait for the end and maybe forget them. Yeah. So the second question is about how organizations can deal with, I would say, risks in smart contracts that are more complex than what we used to interact with solid transactions. Who wanted to take the first question? Cyber.
So the job of a wallet is very simple, is to keep the assets of the user secure. Okay, and so if you don't do that job, your job is not done. Everything else is decoration, is cute. If you provide services to buy and sell and stuff like that, this is great, but this is not the job to be done. And it needs to happen at two levels. The first one is to make sure that you protect the account or the keys, whatever you want to call it, right? Anytime a user loses his keys, the job is not done, right? To come back to Ledger, this is why they're doing what they do, because I don't know if millions of people, a lot of people are losing them, right? In the case of ZenGo, for example, we nearly have 1 million users. So we're a bit smaller than Ledger, but we had 0 account theft in the history of this company of 4 years, which is an outstanding achievement. And this is the job to be done. That's the first level, protect the account. Make sure that no one can lose by human error or by external attacks, and there can be thousands of them, their account. The second one is to protect the transactions, whether those transactions happen wallet to wallet or wallet to contract. This is an enormous field that is untapped. Today you have all sorts of band-aids and patches that are sorts of extension that you can use only on your computer, in addition to an existing wallet that kind of do simulation of transaction and tell you before you press the send button what is going to happen. This is, by the way, a terrible user experience because it doesn't work on mobile, it doesn't work on all the chains, etc. We actually invented that solution. It was the first firewall, we call it ClearSign. It's built into the wallet. It's not an extension, it's not something that you need to think about, it's not something you need to toggle on. It's there when you make the transactions, before you press the send button or the connect button, before you engage with the wallet or the smart contract. It is critical that wallets be part of that also equation. They cannot just say, well, if we protect your keys, we're done with the job, everyone else will do it for you. It has to be baked into the user experience. And I want to say one last thing. When I say user experience, I'm not talking about the cosmetic of it. I'm talking about how the security user experience works. It is important, it is clear, it is understood, it is in context, and it is by default. It is not something that needs to be toggled on. So again, if the job of a wallet, if there is one job a wallet has to do, is security about the account, security about the protection, and both have to happen by default, without toggle, without extensions.
Just to add, just on that point, just to add one more element of how wallets touch into security is a very different kind of angle here is that wallets, right, can serve as authentication devices for logging in, right? And one of the, and we all know this in the room, one of the main challenges of logging into websites today is you have to use passwords, which kind of lend themselves to phishing and things of that sort. And wallets are inherently private-public key pairs, right? And how you store the private key and split it, etc. But there's a fundamental, wallets have this fundamental advantage as compared to current login methods on the security of kind of your interaction online, right? And you can argue it's the same with passkeys, which are kind of a big buzzword that people are moving to in authentication land. But essentially, there's a fundamental change that wallets can lead essentially across the web, which is to get rid of passwords completely and move away to a model that doesn't lend itself to phishing, because there's essentially a private key that never leaves your device or a combination of devices and so on. which you use to sign and kind of prove that you passed a challenge to log in. So there's the concept of how wallets protect, but there's the also concept of how wallets can actually be used as a fundamentally better security apparatus for authentication online as compared to kind of the current login methods out there.
Yeah, I would just add a few things. I think that in the past, wallets were considered like a safe place where you keep things. I will give an example. So we did like a branding a few months ago, Utila, and we met a branding firm, and they sat with us, and they wanted to understand more. And then they just created like some image of a space, right? Like in your office safe, right? In your house, like in the old days. And they were playing around it. And then I told them that they need to understand that how we see it on our end, that wallet is not a safe necessarily anymore. It can also be like a gateway, right? Like an access point. And I think that that's mainly the transition that came also like with smart contract interaction, right? Like it's not anymore the place that only store your assets, it's only the place where you actually access some other like smart contracts or on-chain, etc. So this is like some shift, in my opinion, when you think about wallets compared to a few years ago. And also just something about recovery and all the stories Ledger. I think that in the institutional side, by the way, recovery is something big, and is something that everyone is feeling very comfortable with. So CoinCover, which is I think the provider that now Ledger worked with, actually they have been working for years together with like the biggest institutional custody providers like BitGo, like Fireblocks. And I do think that they're actually, the organizations, when they understand about the huge amounts of money they can lose, they're okay sometimes with like setting like a third party for the backup. It's a bit different in the B2C world, but this is another thing that I just wanted to mention. Regarding DeFi, so I think it, of course, it creates like a new vector of attacks that, you know, like in Israel, for example, you have now many vendors that's the only area that they're trying to focus on and basically solve what's called like on-chain security or DeFi security. And from the wallet perspective, so you can think about a few things like I would say the pre-transaction and the post-transaction, right? So in the pre-transaction, whenever like, let's say a user of a wallet wants to interact with like a smart contract, you want to make sure that this user is actually interacting with the right smart contract. There is no like a front-end attack or anything else. There is maybe like what's the risk score of this smart contract, and then you can, you know, even integrate like one of the new on-chain security players into your wallet and give this visibility layer to the user. You can give a better understanding what they are going to sign on, right? Like, so as you said, it's not anymore about transaction that is getting out of the wallet. It's more about actually moving funds into like some outer place of the wallet and making sure that actually they are moving to the right place. Like the transaction is not created in the wallet anymore. It's created out of the wallet, and you want to make sure that what was created out of the wallet is actually legit, right? So that's like the difference here. So you can give better simulation of the transaction, better understanding what's the risk around this transaction. That's first tool. Second step that you can think of is the governance. So today the governance mostly talks about amounts, but what if the governance will also tell you that you can specify that if we understood that the risk score is like 5 out of 10, then block it right away, okay? So you can also integrate the pre-transaction risk score also into the governance layer, which is like something that we are also thinking to add in a later stage. And there is now the side of the post-transaction. So let's say some funds move to a smart contract, now they are there, now I want to make sure that they will stay there and nothing will happen to them, and then you need like the monitoring and alerting and then to understand if something bad is going to happen, and if yes, maybe automatically you can pull funds out of the wallet. Now actually here there is a difference, because in the end, when you are using like a self-custodial wallet, like let's say Utila or any other one, so we don't have full access into your keys, which means that we cannot automatically move the funds out of the smart contract for you. You need to do it by yourself because you are the owner of your keys. And the only way we can help today is, at least now, is to give you an alert and hope that you will, let's say, wake up in the middle of the night and move your funds out. There are some sophisticated ways that we're thinking about how we can make it work in a way that you will be maybe able to do it automatically, even in a self-custodial wallet. And we're thinking on it. But again, when you do self-custody, you are the owner of your assets. It also means that you need to take care of them when there is an alert at 2 a.m. that someone is rug pulling the smart contract that you interacted with. Yeah.
Just add to what Bentzi just said, that from our perspective, from the infrastructure side, again, thinking about maintaining the self-custody nature of the transaction signed by the user, but still adding some layer of transaction monitoring. The way we do it from an infrastructure layer is adding a relayer level, which basically means once transactions are signed by the user, they're not posted directly onto chain. They're passed through the relayer, which then they're going through transaction monitoring to understand exactly if there are any risk to the transactions. We're also adding the ability for the companies implementing this infrastructure to put any kind of logic and methodology behind what transaction they want to allow to be posted and versus not. So this still gives the companies some certain level of control over the transactions being kind of posted out of those wallets, and also on the security side to enable better transaction monitoring.
Thank you. If there are any questions, again, feel free. Oh, we already have some. So maybe just one follow-up question. So we say that a wallet is a bank, is an identity, a gateway, kind of everything. Sam Altman is going to scan our eyes and generate private keys from our biometric data with WorldCoin. So like, what do you see as like a wallet will be, I don't know, not 2 years from now, like 10 years from now?
I can start, and I'm going to semi-repeat what I said a little bit, so apologies. But if you fast forward if you move back 20 years, right, the way we would interact with websites would be you put your email in and you put a password and you set up an account and you re-enter your information. Then you go to site B and you enter your email and set up a password and you re-enter the same information on website B. And then after you re-enter that information, you would add your credit card on website A and then add your credit card on website B, and so on and so forth, KYC on website A, KYC on website B. The next step to that was Google login or Facebook login, where inherently you would be able to one-click log in. You established your user once, you log into website A, and you log into website B. But after you log into website A, log into website B, you would have to KYC, you would have to enter your credit card, you would have to do a lot of the additional steps after account creation. Wallets are inherently the next step of that, which mean that in 10 years, you will log into a website with a wallet. It can be still called login with Google, but it'll use not OAuth, but kind of the crypto infrastructure as the kind of shared rails. And with one click, you would log into the website. You would have one click, single checkout for the web, sort of like your Amazon one-click checkout, but for anything. You would have multiplayer mode, where you would take what you interacted with on website A and be able to take it with you, an NFT or asset or game, and take it with you to website B. You will be able to communicate via your wallet. So wallet is inherently a communication tool. And you'll be able to do all of that with a single device, which is pretty awesome, right? And so if you fast forward 10 years, wallets are inherently, and they might not be called wallets, and they might not look like wallets, and they might not be branded, and it might be a single application that already is on your phone that turns into a wallet like a Robinhood or a Coinbase or a Steam or any one of those. But in 10 years, the infrastructure in which you interact with websites and apps for single login, for real, true single sign-on for the web, is in sharing your identity and sharing KYC, etc., is a concept of a wallet. It is a fundamentally better infrastructure to do so. It's kind of shared rails that allow you to do payment, that allow you to share identity, that allow you to kind of KYC on website A, tokenize that, and prove that to website B in a privacy-preserving manner. And so that is kind of the vision, and in my opinion, the inevitability of what will happen in 10 years is we will fundamentally use this infrastructure versus OAuth infrastructure versus account creation in order to interact with wallets, apps, etc.
So just to follow up on that, I kind of zoom out, not to talk about wallets, but about the digital economy. I think what we've been observing for the past 12 years is that progressively all sorts of assets that used to be electronic are becoming cryptographic, and so that there is a translation from asset being represented in closed database to on-chain, and there is an enormous economy that is being developed on-chain. If we project a few years from now, it is inevitable that this economy is going to be enormous. Probably at some point, the cryptographic economy, cryptographic-based economy will be vastly superior to the electronic-based economy, the way we know it today, e-commerce, social network, etc. If you accept that reality that has already started, it's not science fiction. Wallets, whatever their form is, whether they are personal wallets and branded wallets, or whether they are embedded wallets or infrastructure plays, are going to become the most important interface to interact with that economy. By far, it will be the starting point and the end point of any type of transaction, of any type of assets, whether those are financial assets, art, game items, your social identity, your proof of whatever, your certificates, your Teudat Zeut, and God knows what else. So everything is going to move on-chain because, as you said, it's a better rail, it's a better infrastructure, and wallets are going to be the primary interface. On-chain wallets, non-custodial wallets are going to be the primary interface, whatever the form is. And I think there will be room for innovation to adapt to that reality. But to me, I mean, I don't know if I see the future, but it looks to me like inevitable.
So all of you have a very bright future. I think you chose the right industry.
If we're still alive, yes.
Yeah. Yes, please. So we have first question, or you can answer whatever you wanted to say. So one is like the anti-crypto KYC thesis. Second one, decentralized access. Odyssey is an Israeli startup building in the space of dynamic MPC, decentralized MPC, all those things, and how do you see access management in your industry? And third, very interesting question, like what's wrong with open banking and embedded finance? Like, you know, Units and Brex and other startups are doing amazing things with e-commerce. They have awesome solutions. And you talked about authentication. Like, you know, I can, with one click, pay with PayPal for like 10 years, you know, so why do we need all those blockchain stuff to solve maybe things that are already solved with traditional financial tools? And fourth questions, like and maybe that can be also the last question, like the end game for wallets. Is there going to be one wallet, or maybe, you know, every brand will have their own wallet?
I can try to take 3 and 4 and then attempt those, and then we'll, you know, pass it on. But first, I think maybe you mentioned something important, which is we have PayPal, and I'll come back. I think your point is critical because you mentioned PayPal. I was just listening to David Marcus talk, who is was the president of PayPal, and now has ironically enough a Bitcoin startup on top of Lightning, right? And his point was PayPal was trying to integrate Venmo for the last 10 years, and you can still not actually move money from Venmo to PayPal. And that's inherently an infrastructure issue, right? Which fundamentally means that, yes, you can build what are all the things we're building today are kind of nicer UIs on top of a broken 1970s system, right? When you transact online, there's a lot of magic and risk management that happens in the background to like create that magical experience for you. But it's fundamentally a broken system, right? That it's not broken. It's just very, very old and clunky, right? And how you reconcile money, how you transfer money, and how it settles, how long a transaction takes to settle, how wires work. The Federal Reserve is just launching Fed Now, and it's an optional program. And there are a lot of there's fundamental advantage at the infrastructure level of crypto. Now, that is not to say, to your question, that is, I want to make sure it's like super clear. I think banks do not need to change at all, nor do I think like having crypto is any criticism of banks. I think they serve a different purpose. Do I think in 10 years I store my money outside a bank on my wallet? Absolutely not, right? Do I think I use a wallet to interact instead of a credit card potentially? Absolutely, which is why I think companies like Visa and MasterCard are investing so much money in crypto, is because they realize that essentially the shared rails that are built instead of their proprietary rails are going to win in the long term. So I actually don't think it's a competitor to a bank, but rather a competitor to a combination of Google login, credit card, wallet that you have on your phone with Apple or Google. That's more the combination there. So I think I'm answering a question there. We'll talk about it more, but yeah, that's how I think about it. Just on the point number 4, and then I'll stop talking, so apologies. But on point number 4, there are two ways to think. I really like the credit card analogy, which is you today, if you're in the US, you likely have like 4 or 5 credit cards. You have your Costco card where you use and you get discounts at Costco, and you have your American Express for like travel, and you have your United card that you use when you buy United flights, and you don't necessarily have one credit card. And wallets are a little bit the same. You don't have I associate a wallet with an identity, and you have multiple identities as a person. You have your gaming identity, and you might have a gaming wallet. And you have your social identity, and you might have a social wallet. And you have your business identity, and you might have a business wallet, right? So I actually don't believe there's a consolidation into 3 or 4 branded wallets, as much as vertical, vertical competition for specific wallets. And a good example is, I think you might have a Robinhood wallet or a Cash App wallet for your financial transactions, and a Steam wallet or anything like that for your gaming related things. And Twitter will become a wallet for your social related activities. So that's a little bit how I think about it. I don't think of a single winner take all. If there is a single winner take all, I might be looking for a new job, but because there's no need for a dynamic like solution. But essentially, I think there are actually a lot of kind of wallets in the end game.
Just to jump on that, I think it will be like an ice cream shop. You will have a lot of flavors based on indeed your need. Definitely not going to be controlled by 1 or 2 players. For sure, it's not the case today. It's not going to be the case in 10 years. However, I think you might always need simplicity in their stack, because they just don't have enough bandwidth and attention for everything. So even though someone might have multiple wallets, the same way they have multiple credit cards, sometimes bank accounts or trading accounts, I think you also need some primary interface to consolidate your essential needs. So I think people will have a variety of accessory or secondary wallets for different type of needs, and the primary interface that might be an independent one, a bit like, for example, PayPal for peer-to-peer transactions, or something that is directly baked into the operating system of whatever device you're using, and that will enable you to get your mind in a sane mode, instead of figuring out where is everything, especially with the rise of embedded wallets and where that's going to be in every single app and every single dApp. People are going to become crazy at some point. They will not know what they have anywhere. They will need to have a consolidation base. So I think, I don't know how many wallets there will be in the future, but I know for a fact that users will have a primary wallet because they just need sanity and they need simplicity.
I will just try to talk about a few points, not like in a specific order, a decentralized answer. Regarding entropy, OTC, so I'm not sure if everyone here is familiar with, yeah, so that's why. So let's talk about Utila. Okay, so we are building a MPC-based B2B wallet. As Ouriel explained before, in MPC you split the secret into at least 2 secrets, and let's say that we split the key into 2 shards. Okay, now in the architecture of a solution like Utila, so 1 shard in most of the cases will be kept on our end, and the other shard will be kept on the customer's end. By the way, regulatory today, besides of, I think, Singapore, it means that we are non-custodial. But it also means that there is one disadvantage here, that in some way, whenever the customer holds a backup, okay? So whenever they want, they can just get out without talking to us, and it's fine. But many times when they want to do a transaction on Utila, it means that they need to go through 1 shard that we hold, which is actually the way for us to enforce the governance layer, right? So we have this database, it is connected, let's say, to the shard, and then we can make sure that no one is moving the funds by mistake to his grandmother wallet, as I talked before. Now, some clever people came, and I know, I met Tux Pacific from Entropy, is an interesting person, and of course the guys from Otzi. And they came and said, okay, why MPC will not be totally decentralized, right? So why there is a need for an entity like Utila or any other MPC provider to own 1 shard, and let's just build some sort of a network of shards that no entity holds. I think that for sure there are organization, retails, they're looking for such a solution. I think I can talk mostly from the institutional side. And then when you come to an institution that holds crypto assets for their behalf or for the behalf of their customers, they want a company actually that they can sue, a company with an SLA, a company that they can call to, right? And I think that's why by design, some sort of a centralized solution in a way makes sense for them. And that's the kind of companies that we are trying to to target. But in the end, I'm sure that there are others that they only care about decentralized, truly decentralized world, and they don't care about SLA, suing anyone, etc. And I think for them, they should look for a decentralized MPC solution when actually I think the go-to-market of these networks is actually to build a wallet on top of them. So it's a bit of a different also strategy in the market. So that's about that. Regarding I would say the use case of crypto, I think so. Itai just mentioned Visa, MasterCard. I will give you a small example of how things are working today and why crypto is a great solution. Think about settlement. So I have an Etsy account. Someone is buying my really nice jewelry, and then I get paid. But basically, if someone paid in credit card, I'm not getting it right away to my bank account. It will take 4 days, 5 days. Maybe there is the banks weekend in the UK or something, and then even more. And what if I could do just instant settlement, right? In 30 minutes on stablecoins. That's actually one example that is actually Visa, MasterCard are working on, and that's a great example of the broken rails that these solutions are built on right today. So I think that's about that. Regarding identity, KYC, and decentralization, I do think there must be some way to at least ensure the identity in some point. It might be decentralized in a way. What I imagine actually is some sort of an identity oracle, if that makes sense, that you only one time do some sort of verification, which is stored on-chain, not in any centralized entity, but it can be all the time be questioned, by a smart contract, if it's just to make sure it's not a terror organization or something. So they don't really need your identities. I just imagine just as an if, asking if this oracle, specifically this identity, is not a terror organization, and then getting yes or no without actually knowing your identity. So I do think that in order to get to mass adoption, you need to to enter some sort of KYC, but you can do it in a still pretty decentralized, anonymous way. Yeah. So.
Just a quick anecdote on the why crypto. So we recently closed a round, and we had some investors that paid us by bank wire, like send the money by bank wire, and some from the US and international, and some sent from Asia in stablecoin. Guess which one arrived faster? Okay, all right, you already know. But more importantly, the headache that we had to deal with to make sure that the money is received by the bank, that is released by the bank, because they need all sorts of documents to make sure that it's AML and everything. The time we spent on dealing on that transaction was completely ridiculous. Eventually everything was fine, but why in 2023 do we have to deal with that insanity? That makes absolutely no sense. We're a non-customer to the bank. They've known us for 5 years. Those are famous investors. They are well known with a track record. Why do we need to go through all those things? And on-chain transactions bring vastly superior, not just user experience, but convenience for a modern era where transactions are very, very common.
I'll say one more sentence to conclude it all. And I'll just say that, touching on regulation, because I think, in my view, this is a huge catalyst in the industry. It's the biggest enabler. The clarity that's now starting to come through in regulation in Europe, the US is still struggling, but they're going to get there as well, is what's going to bring more companies to build Web3 and blockchain-based experience, is what's going to enable more users to feel more safe joining the space and putting their identity on chain. And at the end of the day, I think this is kind of like the way, this is now what we're seeing now in the regulation landscape, is the start of this mass onboarding of users.
Great. So I can keep going on like this for hours, but I know that people have planned the rest of the day. I can just say that Bentzi had very interesting observation that decentralization is not like an ideology, right? It's supposed to be connected to use cases, and he also didn't directly said it, but he talked about like using zero knowledge for proving identity, so you can mark in your bingo cards that we also talked about zero knowledge today. Obviously, we haven't talked about AI. This is the next meetup. Any last question before we wrap it up? Yeah, so repeat, like, what is the, I would say, the most excited wallet feature, or the most disruptive thing that wallets can do in the world? Itai, I think that I know your answer about it. It's related to authentication.
I'll answer from like brands and companies perspective. I think it's certainly around loyalty. That's one of the most exciting themes we've seen in that space.
So just to come back to the prior anecdote, but simple payment, really a killer app. People need to pay for stuff, and paying today is still complicated. I know there is PayPal, I know there is Venmo, don't bring that up. As you mentioned, it's not possible to pay PayPal to Venmo, Venmo to PayPal, PayPal to Cash App. Number one. Number two, the majority of the people in the world are unbanked. They can't have a PayPal account. They can't receive a transaction just like that. And so paying people everywhere in the world in a fair way, in a fast way, in a cheap way, to me is the killer app today, not in the future. We're not talking about sci-fi. Even for a company like us with a reputation and history, it's difficult to get paid. So I think there is something there that is really just in front of us, and I think Wallet enabled that in a fantastic way. It can still be improved, but I think it's already there. There are obviously many other exciting use cases. You talked about account abstraction. I think we are in the early days, still unproven what will be done really with that, but I think today we have already a fantastic use case.
I talked about the identity one, so I'm not going to come back to that, although everyone should learn about the identity part. But I will say one more exciting use case is there's a company, and I mentioned this briefly, that David Marcus created called Lightspark, which ironically, again, uses Bitcoin versus Ethereum. But it takes Lightning, which is kind of the abstraction layer on top of that quote-unquote L2 on top of Bitcoin, and productionizes that. And I think that changes to your point about payment, that has an opportunity to fundamentally change kind of global payments. I think it's like a better transfer-wise, it's a better like PayPal, it's a better a lot of those things. It has a clear technological advantage. And one super smart thing that I think they do is actually they chose Bitcoin which is the one thing that actually has regulatory clarity. Right, it's the one thing that the SEC defined as a commodity, or the thank you, whatever that name is. But that is a fundamental, like an extremely smart concept that I think has an opportunity to, along with stable coins, to see material kind of adoption in a very quick scale.
Yeah, well, that's just a bit because Ouriel and Itai already talked about it, but I definitely think that the next boom is going to be around payments. I already see it in the market. I saw recently a company, I forgot the name, but I like what they do. So they create a link for a payment that you can send, and actually there is already like a wallet that they can create that is embedded into this link. So basically you don't even see the wallet, you just get a link and you pay to this link, but behind it there is a wallet. So this is like taking the wallet and and just making it like a link for payment. I do think payments in specific areas, cross-border, mostly around supply chain. Actually, I see a lot around payroll right now. A lot of organizations, after COVID, of course, working from remote. They have many employees like all over the world. They want to set like instant, quick payroll. I see a lot happening there right now on stable coins. I do think that there is still a need for good bridges, I would say, or good connectivity between like different networks. Circular doing some good work there recently. And I think also today you still need like a very easy connectivity into like traditional finance in the end. In the end, many people, they still want to accept their payments into their bank accounts. So you need like efficient, instant on and off ramps today. And great teams building. We actually recently partnered with a company called Bridge XYZ by the former chief product of Brex. And what they do is like one single API that can on and off ramp you to any US bank account. So those are like some layers of payments that are now being built, and definitely it's going to be the next big boom.
So unfortunately we have to finish two last points. One, you said it's not easy to transfer funds from Venmo to PayPal. It's also not easy to send XRP to a Bitcoin wallet, or to to switch between different L1s. So we still have a lot of infrastructure challenges around bridges, which is probably the most hacked type of infrastructure in the crypto industry. Second, about Lightspark. So we're fortunate enough to invest not in Lightspark but in Breeze, which are also developing Lightning SDK. And Ray was supposed to be here with us, but he got COVID. So that's it. So I want to thank Intel Ignite, and also Jessica from Entrée, and Guy from Kraken, all of your panelists, and you for coming today, this morning. And thank you very much, and see you in our next event.